Badshah joins us now. Taher, good morning. Thank you for joining us. 18,000 on the index happened when crude was at 75, when there was no war in the world, when Fed was supposed to increase rates in a measured manner, and there was no large concern around inflation. महंगाई की मार हिंदुस्तान में नहीं पड़ी थी. All these factors are at play, and markets are almost back to its previous high. What are we missing on?
I think you're right that the recovery post some of these headwinds which came into play has been pretty fast and quick, even for our own expectations. Although we did expect that the market would overall gradually recover, as India seems to be relatively better positioned in general. I mean, while notwithstanding some of these commodity-related headwinds which are there for the near term. So I think what has probably happened is the fact that we've markets have started to treat this whole thing as a little more temporary or transient, at least as far as some of the geopolitical premiums which are there on commodity prices. We've seen some bit of clawback of commodity prices across in the recent past, and that's providing some relief. India has also probably taken some of the fuel price hikes, etc., and maybe there will be some seep-through of inflation as we go into the next some weeks. But I think broadly the market probably wants to still believe that our peak inflation this time around would be relatively lesser compared to what it has been in the past peaks. So we have a starting point on inflation, which is of course we've gone through 3-4 years of very subdued inflation. So in a way, 1 year of maybe stronger inflation is not necessarily going to entirely topple the boat, so to speak. So I think overall, therefore, the market is taking that comfort that even though inflation might be a little stretched for a while, but India will probably end up better. And that's simply because we did not really stimulate our economy as much as probably what some of the developed markets did. So it is, if inflation is largely a function of money supply, then it stands to reason that we may not necessarily see as much of inflation over a cycle compared to what many developed markets are probably countering or are likely to counter at this stage. So I think that's where the recovery has been pretty swift and fast, much better than most of our expectations, I guess.
How do you see a market reacting to the earnings season? Because in all probability, we are in for an earnings downgrade for 2 quarters. Are markets factoring that in? Are markets saying that let's not look at to FY23, let's look at FY24? Is that the assumption which is going?
Well, look, some part of the profitability impact was already visible even prior to this quarter, the March quarter, when we saw maybe string of 2 or 3 quarters where corporate profitability was shrinking, even though it was demonstrating some very healthy top line growth as it was going through the post-COVID recovery. But clearly there was embedded an impact of rising commodity prices. As you called out, crude had already crossed $75, and we'd seen most of other commodity prices like steel, aluminum, etc., also go up prior to the conflict. So I think perhaps the March quarter may not necessarily fully reflect the impact of the further leg up in commodity prices that we've seen post-conflict. And I think that will probably become a little more clear going into the first quarter of next year. So on current reckoning, it seems that there is a fair chance of some downgrades coming about, or at least the market being a little more skeptical about the earnings forecast for FY23 than it was maybe a quarter ago. But we need to see how the interplay of price hikes by corporates in general and the concurrent impact on demand plays out over the subsequent quarters. I would like to think that in general, India is a relatively better place. If you look at it from a starting point, we are at a stage where generally our corporate balance sheets, bank balance sheets, maybe even you can argue household and government balance sheets are not necessarily as bad. I mean, they are at a reasonably decent starting point. And so I think if we can successfully overcome this commodity price related challenge over the next few quarters, then I think market is clearly wanting to bet on a better economic cycle coming for India. Perhaps not as strongly in 23, but clearly beyond that.
Taher, given that all banks are now, at least big banks now, are looking at either consolidating or buying big businesses, for example, the Access City deal, HDFC Bank merger, how do you see things changing now for small financials? I mean, will they be, I mean, as a fund manager, would you be tempted to buy them because they are cheap, or you would say, look, these small banks are going to be relevant now?
Well, I think in general, I mean, I think while we've been positive on banks for a while, and we've now started to see some interest come back, and that's a good thing to see. And that's been our calling card over the last 2-3 quarters, that financials and BFSI in general is well positioned for at least a cyclical uptick, if not anything else. There have been some apprehensions regarding new fintechs, etc., which have been coming in the way, and therefore some impact on the profitability of the banking sector. And in as a totality, therefore, our opinion or our approach has been that at least as far as banking is concerned, that we focus more on the larger banks or the frontline banks, both in the private as well as the public space. So my sense is when we look at it from an investment standpoint, at least, large banks are relatively better placed at this stage compared to the mid-sized banks, because there is generally mid-sized banks have found it difficult to kind of scale up over a period of time. I mean, relatively few instances of many mid-sized banks having graduated to becoming large. So, but they can all benefit from a cyclical uptrend, and that's clearly possible, especially now that there is good evidence that credit growth in the system overall is looking up, although we'll have to see how market shares behave going forward.
That's right. At least the business updates that we started to get for the quarter gone by are certainly encouraging. HDFC Bank up by 20%, loan growth year on year. Bajaj Finance 29%, IndusInd Bank 25% sequentially. Good morning, Taher. And as we head into earnings season, just wanted to get a quick word on that. So we've got some idea as far as the business operational updates go. But for this quarter that will be under review, and Q1, Q2, there could be problems as far as inflation goes that could squeeze out margins. That's been a theme that has been playing out. So as a fund manager, how would you go into earnings season? Is there some skepticism? Is there any concern that we could coming into a season of downgrades as well, earning downgrades?
So like as I called out, it's probably going to be a little difficult for earnings to start looking very distorted in this quarter itself. The impact of commodity prices was already evident even prior to this fresh leg up in commodity prices that we saw post-conflict. So there was continuing pressure, but interestingly, many of the corporates in the third quarter result updates have called out for more vigorous price hikes in their final product lines compared to the past. And I think we've seen that as well with many FMCG, auto, consumer companies, especially those who are obviously at the receiving end of commodity prices. So I think maybe there will be some offset as well for this quarter. Unfortunately, some part of these price increases would have kind of been expended against the further leg up that they saw in commodity prices. So a little hard to say. There will be inventory related, influences too on the profitability for this quarter. But I think market has kind of braced up for that possibility, as I said, of being a little skeptical about the earnings being met. But what we've started off with saying earnings, at least for the Nifty, would probably go up by say 20% plus over FY23. Now, if that were to probably get downgraded, and we'd be likely to end up more like 15-16%. When we take a more bottom-up analysis, sector by sector, etc., it doesn't look like therefore the world falls apart. So yes, some bit of that derating was or degradation in multiples was warranted as a result, and that has happened. It's like as I said, it's been a little surprising to see the market make such a strong comeback in a very short period of time. But perhaps the market is right now wanting to see beyond FY23 or see more evidence that the higher commodity prices and subsequent increase in product prices is likely to lead to demand destruction.
Taher, when we see the markets come back, we also see excitement in the broader universe. That's what's happened in the past. So with what's happening, how would you approach the small caps and the mid caps? What is your strategy? I remember you recently saying you were M-cap agnostic when it came to the industrial space in the broader universe.
So, typically, we look at 2-3 factors which generally are found to influence mid caps and small caps relative to large caps. So, one is, of course, as we all know, the valuation differentials between the two. And the second, typically, what we've observed, which we're also privy to, is where we are in the interest rate or liquidity cycle in general in the economy. And the third is also about where we are in the economic cycle itself. So, on all these three parameters, at least the first two probably do not, seem to be very favorable in the sense that, mid and small caps are not at some stark discount. Liquidity cycle, we all know incrementally is not going to be as great as what it had been in the last 2 years. But we are still in the midst of a expanding economic cycle is what we would like to believe. And if that being the case, so on balance, at this stage, I'm once again reiterating the same thing, that we're kind of agnostic to mid caps, small caps versus large caps as a bunch. We don't have enough to say that we should be at one extreme or the other. What we, however, find is sectorally, when we look at it, we find maybe better opportunities in large caps in certain sectors and better opportunities in mid and small caps in a few sectors. And in certain sectors, we find we are agnostic entirely to whether, there are opportunities both in the large and mid cap space. So for example, as I called out, in banks, we probably like the larger banks. Whereas in case of maybe technology, for example, we might have a leaning towards some of the mid-size technology corporates. Maybe in industrials, it's a mixed bag. We are kind of agnostic to whether we think large and mid both make sense out there. So we're likely to cut it. We're cutting it more sectorally rather than taking a broad market call on the market caps.
Right. Okay, Taher, great to have you on the show. We let you go on that note. Thank you as always for stopping by.
Thank you. Thanks,